You've probably heard about microfinance, where a modest amount of money is provided to a person who has no financial means. This capital is used to start a business and allow that person to become economically self-sufficient. What about scaling that idea to provide the economic means for entrepreneurs to transform underserved communities? This effort has gained momentum in recent years under the heading of impact investing. My name is Jim Connor. Welcome to Game Changers Silicon Valley. In this segment, we'll look at the rise of impact investing. My guests are Catherine Berman, CEO and founder of CNote, and Eric Thurman, a managing partner at Three Bridge Wealth Advisors. So Eric and Kat, thanks for joining us at the show tonight. Eric, I'd like to start with you to give us an overview of what is this category of alternative investments, and where does impact investing and social investing fit in that category?
So alternative investments, loosely defined, is anything except stocks, bonds, and cash. That include venture, private equity, private credit, a lot of different areas that may not historically be investments that people are familiar with. The impact investing space is really considered the area that anything that has a measurable social or economic benefit as well as a financial return.
What about social investing?
Social investing. So the difference in the public markets, we look at social responsible and social governance as a way to see how companies are impacting and from a governance standpoint. Impact investing, and again, these are loosely defined as companies or organizations or funds, again, that specifically are looking at double bottom line impact returns.
Okay, now you as a money manager or investment wealth manager, I should say, you are representing you're looking for the best way to deploy the funds of your client.
Historically, our clients are all entrepreneurs or successful venture capitalists. And when we look at investing many times in the charitable space, it's always been toward family foundations or other ways that we directly give to charity. But now, this whole area of impact investing is how do we do well and do good?
Kat, welcome back. You've got an absolutely fascinating business model that you're pursuing with CNote. Why don't you tell us a little bit about that?
Sure. So the company's called CNote, mycnote.com, the URL. And the genesis was really looking at our alternatives in savings. So if you think about all the innovation that's happening right now in the financial services sector, and I had recently come from a managing director role at a very large financial services firm. And what I found is there was tremendous innovation in the equity space when if you thought about robo-advisors and ETFs and trading platforms. But where we didn't see a lot of innovation is what I call this low risk or savings market. And you think about those in the US with savings account, they're sitting on at the minimum $600 billion in extra savings. If you think about the CD market, conservatively is a $300 billion market. So there's a lot of money sitting there that in these interest rate environments are not doing much of anything. And so really the challenge for us as a team was to innovate around that space and say, what could we build that could provide greater yield to good savers, but also do a potential good in the communities. And so this is when we came up with this concept of CNote, and we did this by partnering with an established financial institution called CDFIs, which stands for Community Development Financial Institutions.
I have to ask you a little more about that because what is the connection? Does CDI then channel money to the impact investing environment?
Yeah, so CDFIs are essentially a lending network, and one of the vehicles banks use to lend out money responsibly are these CDFIs, these financial institutions. What makes them a bit different in lending is they actually have a mission, and their mission is to lend to underserved communities. Those include low-income communities, minorities, women borrowers, often high potential entrepreneurs, but that traditionally get underserved or denied at banks. And so this CDFI kind of construct came about over 20 years ago in the early 1990s when the Treasury Department said, traditional banks, we're going to give you an incentive and an easier way to deploy capital in these communities by setting up these intermediary institutions, CDFIs. But what started as this interesting experiment of let's try to set up these intermediary institutions turned into an absolute success story as it relates to a financial institution. And so to date, we have over 1,000 successful CDFIs across the country. It's over a $100 billion market. And their performance is extraordinary. So when you think about small business lending, most of us tend to think high risk. But to the contrary, these institutions have just really learned their craft so well that CDFIs on average have less than a 3% default rate and less than a 1% net chargeback rate. So excellent at what they do. What we discovered at CNote was there was an opportunity to do even more. And so instead of going through banks who ultimately get to CDFIs, what if retail investors could go directly to CDFIs and then in turn get the majority of interest? So that's essentially what we've done. We've partnered with some of the nation's largest and most reputable CDFIs. With that, savers get a 2.5% yield, which is much better than the 0% they're getting in traditional banks. No fees, principal insured. So a really nice competitive yield product that also does great in the communities.
But I just want to make sure I got it right. So traditionally, the bank would put their money in a CDFI,
That's
correct?
right.
And what you're empowering or bringing to the market is the ability of an individual to go to the CDFI and get that same return, and then the CDFI is moving that money into impact investing opportunities.
That's exactly right.
What do you think of this idea? Does this have any appeal to you in your wealth management business?
It does. On a number of levels. One, preservation. Obviously, our clients are looking at preservation, looking as an alternative income source in a zero interest rate environment globally. And then also have that double line or impact investment focus. It's kind of the nice Venn diagram between all the three of those that makes it fairly interesting for our clients as an opportunity.
Will you invest on behalf of your clients, or will you just take a position as your firm and then parcel back pro rata to those people?
We always have clients invest directly in all of our investments, and we act as the advisor in between to help manage the capital calls and everything else involved with those investment structures.
Do you have to sell the idea to your clients, or do they ask you for it?
You know, more and more, we're getting conversations that are brought to us by our clients, a lot of the millennials now, talking more about impact investing, how they want to use the capital that comes from these exits to have more of an impact beyond just return. But there are more and more opportunities that we are seeing and more discussions that we're having kind of across all asset classes that may have a double bottom line impact.
You're taking money in now from individuals? Did you get bank regulatory approval to do this?
We are doing this business based on a fundamental principle of integrity. I think we've seen a lot of things go not so well in financial services, and we believe that really a new era is coming of high integrity, complete transparency, and simplicity for the end client, for the end saver, investor, whomever. We really wanted to make sure before we launched that the pipes were working correctly, that we could really identify the best CDFIs in the country, because there is quite variance across CDFIs, that the industry, the CDFI industry nationally was open to this type of innovation, and that obviously product market fit was there, that truly in this low interest rate environment, folks were as hungry for a yield product as we thought, especially packaged in this really easy, automated, transparent way.
So if an individual comes to you, give me a typical scenario. How much money would they place with your firm to go to a CDFI?
It's a great question. So on average, the clients that have come our way place anywhere between $20,000 to $50,000 out of the gate. And then the hope is obviously that we can gain their trust and their loyalty to really see that increase over the years. I like to call us a midterm savings product, in the sense that we're not your checking account or ATM. And at the same time, we're not going to tie up your liquidity like a CD. And so we sit in that nice sweet spot where folks who are looking for their first, home down payment, or fundraising for their business, or looking for fixed income or a new cash management strategy for their overall performance, we really meet that need right now for more competitive return.
What is the typical term of that, let's say $50,000 investment? Is it 5 years, 4 years, or variable?
Quarterly liquidity. Yeah, so very
Really?
important for us is accessibility. The market that we're serving craves liquidity. And to Eric's earlier point, thinking about millennials, thinking about a lot of high net worth families, thinking about women, a lot of different segments that are kind of looking for this type of product. One thing is common, and the consistent theme is wanting access to those dollars. And so right now we're launching with quarterly liquidity. However, we're looking to actually shrink that to monthly liquidity sometime next year.
Does your firm have to provide the liquidity, or is it coming back from the CDFI?
Yeah, it's actually a liquidity matching algorithm we've developed. So to actually create this as a standardized, scalable product, we make it sound very simple. It was not. It is not a plug and play, and that's why it's not been done before.
Okay, very good. Wow, that quarterly liquidity call option sounds like a pretty appealing thing. And is that one of the attractive advantages of this program that you see?
We always think it's important to match assets and liabilities. So we want to look at the underlying investments to make sure that we can match those and feel comfortable that there would be that kind of liquidity. finding an investment structure that does have quarterly or monthly liquidity that gets better than zero and money market returns is very interesting. And then and adding on the double bottom line adds that additional kind of interest level. But there's a lot of interest in, again, as we mentioned, clients that have money that they may not need for 24 months or 36 months that is really sitting in a lot of cash right now at zero. And this, is a reasonable alternative for some of that capital.
I have to ask this question. Do you check out her CDFIs? Do you do a quality rating on them? Or do you provide a quality rating on them? Or are they guaranteed by the government?
It's a great question. One of the key variables and benefits that we provide as a company is diligence on CDFIs. We have actually a very strict 3-part diligence process to look at CDFIs. We start with the ones that are rated. So there actually is a CDFI rating agency called ERIS. And so we start at that level. And we start those that have incredible track records working with government guarantees. And so kind of knowing where to start is really an advantage. And then secondary, then we dive in. And so the diligence process, which includes our leadership team, which includes the ERIS leadership team, and a third-party contract, allows us to really find the best ones and then monitor them, obviously, year over year.
And that's going to be an attractive part to you also.
It is.
Then.
I mean, there's no way in every one of these asset classes we can go do individual diligence on transactions. We have to find the right people with the expertise in a marketplace to be able to do that on our behalf and trust that those are the experts in the space to manage capital on behalf of our families.
Is this a 2.5% return across the board with all CDFIs, or is it variable?
It's variable, but that's part of our magic. Our ability to work with CDFIs and build that trust and negotiate, because we want them to win too. And I think that's a really important part of this story is this is not us starting an entity next to CDFIs. This is a true integration. And I say that because I truly believe CDFIs are the good guys of finance. I think they've done a phenomenal job with small business lending, especially at a time when major banks have pulled back dramatically for small business lending. And so we think this is opportunity not just to provide them access to new, exciting retail capital, but also elevate the industry as a whole. And that's a commitment that we have. And so that percentage, if you will, is something that we negotiate for both sides, not just for our side.
Good. So Eric, I want to spend a little time with you about your firm.
So my partners and I launched this firm in the middle of the financial crisis. And we
2008.
2008. We had the red pill, blue pill moment. And that was, we wanted to be trusted advisors for these people. And to be able to do that, we wanted an independent, transparent, objective platform so that we can always be providing advice we felt was best for our families. We felt this was the best way to do it. So this was us taking on that entrepreneurial role as well. Our clients, because of the nature of where they are, sitting in Silicon Valley and managing and running very interesting technology businesses, trying to change the world in a lot of places, we're able to access unique opportunities and do things outside of the traditional platforms and do some things that are really unique and impactful for the families with whom we're doing business.
Do you ever say no to a client's desires or preferences and say it's not appropriate for what we do?
It's a great question. A lot of our great ideas come from our clients. One of our clients was introduced us to this opportunity. And we are kind of, I would say, the gatekeeper. So it is one of our roles to make sure that when clients are looking at things that we will kind of give them the sniff test to make sure whether this is a good idea, what we might see in that space versus what they're looking at, and give them some advice on that. And through that, we will say no to a lot of the things they're looking at, but if there are good ideas, we may incorporate it to the other families with whom we do business.
Well, this is a great story. Let me do this. Let's go ahead and get your contact information, because I just have the impression that people are going to want to follow up with both of you, frankly. So, Catherine, what's the best way for someone to follow up with you or the company? So
the company is called CNote. You can find us at mycnote.com. Absolutely, kind of register on mycnote.com, put in your information, and then shortly we'll open up your CNote account, get you saving.
And Eric, what's the best way for people to reach you or your firm?
Email is eric@threebridgewa.com, and the website is www.threebridgewa.com.
I want to thank both of you, Catherine Berman, Eric Thurber, for coming in tonight. It's been really enjoyable. I mean, this is such an innovative story. You had me spellbound here the whole time, so we'll have to keep in touch on this and see how this goes.
Thank you.
Thank you. This is Jim Connor. Thank you for joining us for this week's episode of Game Changers Silicon Valley. Each week, we'll address an area of innovation that may emerge as a game changer of tomorrow. You can follow us on our website, gamechangers.tv, Facebook, or Twitter. We look forward to your continued interest in upcoming shows.